This webinar is Buy-Side Collateral Management, Challenges and Opportunities. The webinar will be presented by Paul Wilson and David Field. Paul Wilson is Product Director for 4sight, responsible for working with our clients, both current and prospective, on their securities finance, repo and cross-asset class collateral management solutions, with a particular focus on enterprise-wide collateral management. David Field is Executive Director at Rule Financial and a recognised industry leader in collateral management, particularly with a focus on regulatory change. David oversees large-scale transformation engagements covering organisational processes and technology change. Today's presentation will have three strands. First being challenges faced by buy-side firms relating to current and future collateral management. The second theme is solutions and choices for the buy-side for collateral management. And finally, return on investment and where to start. Please feel free to ask a question by using the chat facility on your webinar control panel throughout the webinar. We will be sending a copy of the webinar recording in a few days to all participants. At this point, before Paul and David begin the main content of the webinar, I would like to invite you to participate in a quick poll in which we'd like to determine who our audience is. You should see the poll on your screen right now. And so please select which organisation most closely matches who you represent, and we will show you the results in approximately 30 seconds. We will be running additional polls throughout the webinar, so please be aware that your participation in these polls is anonymous. Okay, thank you very much. So we have a good mix of participants in today's webinar, with the majority coming from other. Okay, at this point, I'm going to hand you over to Paul Wilson, who is going to begin our presentation today.
Thanks very much, Sinead. Hello, everybody. This is Paul Wilson from 4sight. I'm just going to set the scene. Really, we are looking at a landscape that's changing for all participants across the market. Particularly today, we're going to look at those challenges faced by buy-side firms. And as you can see in the word cloud across on the left-hand side, there's a range of functional areas that really are important, the buzzwords, if you will. CCP selection, repo, segregation models, risk, all of these things that are making your world more complicated, particularly related to the move to trading via CCPs, the cleared derivatives model, or in many of the buy-side cases, more appropriately known as trading through clearing brokers or FCMs. The challenges that regulation has created are really causing a cost basis that's increasing. So your bottom line is being affected by the collateral management function that we have. How you manage that collateral, how you use collateral, become a key performance indicator for many firms. It's actually an important cost center now. And for some buy-side firms, in fact, it's also a way to generate alpha because you may have access to a lot of liquidity that the market does need. So what we're thinking about here is how you take an active approach, how you work out where to start and where you'd like to be, and how you make collateral management, as we've described it, a core competency that outperforms other competitors of yours in the market. Now, we know that the landscape is changing, and we want to just set the scene for where we think it's going to be. So we've heard lots about the so-called collateral crunch. Now, David, what do you think the landscape's going to be in the near future, and how bad do you think it's going to be?
Thanks, Paul. It's David Field speaking. There's been a lot of chatter on the conference circuit in the last couple of years about an impending collateral crunch. But the sense that we're getting is that it's really not going to be as bad as people thought. I think the real crunch will be more of an onboarding crunch, and no doubt we'll talk about that later on in this webinar. The estimates, I'm sure everybody will have seen them by now, came from a combination of ISDA, Bank of England, etc., which estimates that across the residual bilateral uncleared OTC derivatives, across cleared and across, particularly for the sell side, liquidity coverage ratios, which requires a third tranche of collateral to be lodged by banks, it all adds up in normal market conditions to about 2 trillion. It's not all at once. You can see on this timeline that as various regulations kick in, Dodd-Frank's already in place, EMIR, mandatory clearing, maybe Q4 this year, maybe more likely Q1 next year. There's talk of even that date slipping, although nothing official. But at some point in a few quarters from now. Then you've got Basel III, which is the liquidity coverage ratio, kicks in initially at 60% compliance, then gradually steps up. And by December 15, the most recent date I've heard is when the Basel III bilateral margin rules kick in. So over time, there are various incremental steps, at the end of which the various industry bodies have reckoned a total of around 2 trillion. That, of course, is normal market conditions, but in highly volatile conditions, you'd expect that to go up. Bilateral counterparts would expect to take more margin as VAR models on estimating potential future exposure reflect higher volatility. They'll generate higher IM calls. As there's greater market movement, you expect higher VM calls. And I have calculated that in volatile conditions, the additional collateral may be as much as 11 trillion. But even though that's a large number, the market feel seems to be that the collateral is out there. It's just not necessarily accessible at the moment. So it's a question of flushing out that collateral, making it accessible from the pools where it is, getting it into the system, and I think some of the tri-party vendors have a large part to play in getting that liquidity available. Nonetheless, 2 trillion is a lot of collateral, so it's worth reminding ourselves why the politicians and regulators are pushing for this. Paul.
Yeah, so we all know and mustn't forget that we're talking about a risk mitigation function. Collateral management is potentially the best risk management mechanism the market can think of at the moment. We've seen the impact of it in the past and mulled over that ad nauseam, but fundamentally what we're talking about here is how we can see what our margin calls, pledges, exposures are, not just bilaterally, but with CCPs and clearing brokers, and in many cases to many CCPs, many clearing brokers, as well as your bilateral activity that you know and love and are used to dealing with. And we have many clients on the buy side who are now getting familiar with the cleared margin in the US with Dodd-Frank, and it's about to ramp up in Europe too. Predominantly, the most important thing is the visibility on where your collateral is, what your inventory is, how it's being used, what's allocated, what's unencumbered. And it's not just your own, it's across your funds, your clients, outsourced, and whatever your mix of business is. Margin calls have become a lot more dynamic daily with multiple components. So we're talking about initial margin, we're talking about separating out IA, we're talking about variation margin being materially more complex because there's many components within it. So we're going to be moving. It's a lot more dynamic. And all the time we're doing this, we're trying to do it without increasing our costs massively. So we want to keep the headcount down whilst having the most educated team of people in your cost center, because this tends to be centralized more now. And we want to minimize the performance drag. We want to make sure that you're allocating the cheapest that you can using your inventory or doing collateral transformation in an intelligent way. Now, as I mentioned, we may agree or not that this is the best risk management mechanism at the moment, but it does introduce lots of complexity, the challenges that we're going to discuss in the next section. And we're going to go into some of the layers of these challenges now. We're going to dive a bit more in depth with them. David's going to kick that off with a look at the current changes in your general collateralization model.
So here we have a very simple graphic of a very high-level representation of today's world. So we have portfolio managers who are seeking alpha through cash instruments and hedging, or maybe seeking alpha through derivatives. So trades come into some kind of trading system, which is monitored by the portfolio managers. So pretty straightforward. Typically what we're seeing is many of the buy side are collateralizing with cash, often running off spreadsheets, using dealing with IA calls on a relatively infrequent basis. The big change that's coming up is that as the quantity of collateral rises, there is typically not enough cash in the funds, and nor would you expect there to be, to meet all the future collateral calls using cash. So what we're seeing is a major expectation, a big drive towards non-cash. In some cases, firms going from 100% cash to, say, 50-50. In some cases, maybe further. So the big step up in complexity is primarily driven from the drive to non-cash. So in this instance, the complexity of the business functions that you need in your collateral management function in the future, we could simplify into these 4 big blocks. So somewhere you need to be managing inventory. So there's inventory of eligible assets by fund to meet the various pledges for bilateral and cleared margin calls, the actual dealing with the margin calls themselves and how they're collateralized, dealing with surpluses, recalling uncovered collateral. There's a whole raft of new reference data management that is going to need to be managed, for example, eligibility schedules, haircut schedules, etc. Then you have to deal with the fund mandates around risk management, dealing with compliance, internal audit, etc. A whole set of messaging with the outside world, with brokers and FCMs and with bilateral counterparts, dealing with much more frequent collateral movements and much more complex because we're dealing with securities rather than cash. So you can see that functionally there is a significant step up in the complexity of the business organization. And essentially that's what we see one of the major challenges around this. This is a functional view. The question really is then what are the business processes that are going to be exercising these functions? So we could step through a whole raft of process models. That would be a webinar in its whole right. Today we're just going to look at a simple process. Let's take maybe margining as an example. Over to you, Paul.
Okay, thanks, David. One of the things that we come across a lot being as a vendor is particularly with buy-side firms, is the change in the landscape of how you just do something which on paper is as simple as managing your margin calls. So in the olden days, now also with continuing bilateral derivatives or repo or stock lending margining purposes, there'd be the buy-side firm, the counterparties. You may be going through a clearing broker of some description or an agent to manage your collateral, but ultimately periodic margin calls, increasingly on a daily basis, some monthly billing, and a lot of cash. So whilst there are firms that do use non-cash collateral, there's still a predominance of cash in the market for various reasons, not least of which is the fact that it's operationally simple to deal with. However, this is changing. And the way it's changing is quite complex. And obviously, many of you on the call will understand what I'm talking about when I go through this particular model here, which is how it is now for an ever-increasing proportion of your derivatives business or your client's derivatives business. And really the most important one is the split between initial margin and variation margin, with the additional complexity of daily movements for PAI, but also monthly billing, coupons, dividends, fees, of which there are various types, plus the FCM's default contributions. By PAI, for those who don't know, I'm talking about the interest on variation margin, which is usually payable daily and which has its own world of complexity to itself. And I won't drill into that right now, but suffice to say that we're talking about daily management of these kind of flows for buy-side firms who may only have one clearing broker but may also have multiple, up to 10 in some of the cases that we know of, with multiple CCPs. Now, this involves more intensive processing, and there's a couple of challenges here. First one is that there's no standardization for this process as yet. It is coming, but most of the clearing brokers have their own formats, their own periodicity, their own means of you getting to their data. It's also quite complex. You can have a file which tells you what your variation margin, which contains 149 different fields. You don't need them all. So you have to deal with it, and the way that a lot of our clients are dealing with it at the moment, because it's now, it's instant, is through some pretty impressive spreadsheets. But this doesn't scale because as your clients do more and more business through CCPs, the margin calls require a lot more complexity of activity. And where you need to use non-cash collateral, it becomes even more complex because you have to find it. You have to be able to pledge it out there. And we're talking about the whole flow from front to back, managing your inventory, managing your exposures, managing how you want to deal with the components of variation margin. Do you net the PAI with the variation margin? Do you separate out the coupons and fees? These are all questions which need answers within your target operating model, and they need a solution that, if you're using a spreadsheet, involves very manual processes, usually by a team of people. Now, we can see that there is a market prediction that there's going to be a significant increase in the number of collateral movements. So this is only going to get bigger. So it's something that we need to be approaching in a systematic and strategic way. And this isn't all of the challenge. We're going to cover a couple more challenges as well before we move on to solutions. And at this point, I'm going to hand over to David to discuss the layer of complexity that you find when choosing CCPs, which is specifically related to what segregation models you or your client may want to participate under.
Thank you, Paul. Yes, unfortunately, the problem compounds when you start thinking about collateral segregation. So there's been a lot of talk around this as well, and quite a lot of confusion between omnibus models, LSOC, individual seg, full physical seg, a lot of terminology banded around, and not as much understanding in the buy side as perhaps there should be. So I'll cover the three broad models at a very high level, and there'll be many on the call aware there's a lot more complexity to it than we have time to cover today. But in broad terms, omnibus means, under the new regulation, at least as a buy-side firm, your collateral is segregated from the collateral and the positions of your broker. Today, this side of the regulation, your positions and collateral may be commingled with your broker, which means there's some serious disentanglement problems should your broker default. At least under the new reg, even under omnibus, at least client collateral is separated from house collateral. However, client collateral is commingled with all of the other clients' collateral, so at the CCP level, there's only one account with all of that particular broker's client collateral in it. So in the event of a default, the CCP simply is going to share the losses across that account, which means that any individual client is exposed to some mutualization of loss. The advantages of omnibus is it's very simple to operate, low cost, but it arguably has the highest risk because you are exposed to mutualization of risk. So to address that, under Dodd-Frank, there's the concept of LSOC, legally segregated, operationally commingled, and under EMIR, the concept of individual segregation. The idea being here that your broker will hold individual accounts in your name and their name at the CCP, which means that in the event of broker default, the CCP can at least see what your what collateral is due to you. So as they are liquidating the account of that defaulted broker in order to cover their positions, you at least are entitled to get back the cash value of the collateral that you placed. So that's an advantage, so you're not exposed to mutualization of loss. On the other hand, do you want the cash back? Probably not. If you've pledged assets that were held in a fund, probably you wanted the alpha of the market exposure of those assets, so to get the cash back leaves you still exposed to replacement cost risk. So that leaves then open the third option, which is often referred to as full physical segregation, which is not a regulatory requirement. There's no obligation for CCPs or brokers to offer you full physical seg. It's a market product, a market service that's developed in anticipation, particularly in Europe, of anticipated client demand. Here, the broker holds an account at the CCP in your name, and the CCP, who is settling collateral at the CSD, is also holding an account which is segregated. So the account at the CSD is held in the broker, and the CCP's name. So in the event of defaulting in that value chain, the actual assets at the CCP, the ultimate books and records, the registration, is held in your name, which means you get the assets back. So why would anybody not go for a full physical seg when you've got maximum security? The downside is proliferation of accounts. So you're paying per account, there's a lot more messaging involved, a lot more fragmentation of collateral, so the operational overhead and the actual costs and the messaging is a good deal higher for full physical seg. So it's by no means a done deal that it's necessarily the right answer for everybody. In fact, what we're anticipating is that individual funds or portfolios may choose different segregation models depending on where they sit on the spectrum of their preference for low cost versus their preference for low risk. So it requires, unfortunately, some quite serious analysis in order to work out what is the best model. And of course, for many investment managers, you may also be managing third-party funds, so you have to agree that with your own clients, and you may also be outsourcing fund management to other third parties who you will want to make sure that your segregation preferences are expressed with them. So perhaps if we could have the next slide, thank you. So in summary, omnibus segregation, lowest cost but the most residual risk, passing through individual seg and LSOC right through to full seg where you've got the lowest risk but the highest costs. So what you need to do is engage with the FCMs and clearing brokers and the CCPs to understand the variation in these models. You need to engage as a buy-side firm, as an investment manager, with your clients and their funds to explain what the options are and decide both for your own funds and for your clients' funds what the right model is. And then there are some significant operating model implications that you need to work through. So you need to create books and records structures to match the segregation models that you've chosen. You need to create message infrastructure. You need to create controls, in particular reconciliations, so you can be confident that where your assets are placed, what's encumbered, what's unencumbered, what venues they're sitting in, matches where you expect it to be in order to comply with fund mandates. Paul, I don't think that's the end of the story, is it?
It's not the end of the story. So what we're going to look at next, the third challenge, is the final challenge in our list of challenges. We could have chosen more, but we haven't got all day, is about collateral transformation. Really, what do you have that you can use that's eligible? It might be that you're the kind of firm that has access to a large portfolio of liquid assets, which you are allowed to use to cover your clients' exposures, both bilaterally and with CCPs. Maybe that you're already a buy-side firm which is doing a lot of non-cash collateralization anyway, and it may be that you're also quite relatively advanced in terms of trying to optimize that use of collateral. And we certainly have experience of some larger buy-side firms who are in that stage yet. But you also might be, albeit doing that for your bilateral activity, but maybe you're not necessarily ready to do that for your cleared derivatives, be it through various operational challenges. But in a simple status, if you want to, you can pledge collateral directly through your FCM to the CCP if you have it at your disposal. Now that's further compounded complexity-wise by the fact that you will have tens, hundreds, thousands of clients who have multiple accounts, some of which may well be linked to individual CSAs, but others of which are not. So the complexity of sourcing that collateral within a system is quite sizable, which actually explains why there are many large buy-side firms simply pledging cash to their FCMs and the FCMs dealing with the CCPs, because simply understanding exactly which location each client's assets are that can be used, especially when there are multiple locations, has settlement implications of which you may not have had to deal with before. Now you do, and increasingly so. Then there's maybe the second model where you may not have access to liquid non-cash assets that you can use as eligible collateral for CCPs, in which case you're going to have to outsource that to somebody else, maybe through a clearing broker collateral transformation service, or by using other market participants who offer that kind of service as well, who may well take your cash or other non-eligible assets and provide you with what you need that's eligible through your clearing broker to pledge out to the CCPs. Also, it may be that you're a buy-side firm who already has or is planning to do their own internal collateral desk, maybe through a repo desk or the stock lending desk, where you can actually locate assets, bring assets into the firm, pledge them directly out to the CCPs yourself. In any case, this collateral transformation picture here, it's not just one of those answers, it's multiple answers. There's also the need to match maturities of collateral with the actual derivative portfolios that underpin them. There's constraints which are on your FCMs related to balance sheets. There's charges on that and other activity the FCM needs to cover their costs for back to the buy-side firm. So if you're managing this collateral transformation process, there are costs involved, and you can either move in-house, move out, depending on what your universe of acceptable and movable assets are across your business and your client's business. It's not a fixed thing at all. The other problem around collateral transformation and the use of transformation is simply being able to identify what your assets are and where they are. As simple as that. So a single consolidated view of your and your client's inventory, both what's there available and what's been used and where it is, and knowing what you can rehypothecate and what you can pull back. And that's really one of the challenges that faces vendors like 4sight, because we have to be able to cope with all of those additional complexities that didn't used to be there in the previous solely bilateral and tri-party world. Now, these are three challenges that we've talked about: collateral transformation, segregation models, and the general change in the market target operating model. And at this point, I think we'll just summarize the challenges, and we will then, I think we'll run a quick poll before we move on to the solutions to these challenges. And I'm going to hand over to David for that piece.
So in summary, on this part of the presentation, we've covered some of the challenges we see. There's the simple stepping up to a significantly higher quantity of collateral that's required, and that's got to be found from somewhere. And depending on the nature of the fund, it may simply not have collateral in it, assets in it, that are eligible at CCPs. There's the challenge of managing risk, whether that be the market risk as you move more into a non-cash environment of revaluing collateral as well as revaluing positions, and therefore meeting incremental margin calls. The operational risk of dealing with all of these additional business functions and business processes, all of which requires some rethinking on the business operating model, not least of which is the books and records implications and the cost and risk implications of choosing the appropriate segregation model, and the sourcing through transformation of collateral that is eligible for CCP pledging if you don't have it available. And of course, all of that really you want to try and do with minimizing headcount. So, which should be a buy-side firm that is keen on hiring armies of headcount. Nobody is. Minimum capital cost, so avoiding fixed cost increases if you can, but at the same time avoiding unacceptable operational risk. And whilst many small and medium-sized investment managers are probably currently managing cash collateralization in spreadsheets, I hope you can see at this point that's pretty much, in our view, a non-starter in the future. That would probably be imposing intolerable operational risk and key man dependencies on the firm. So there are significant challenges. However, not least of which because some of the regulatory dates have moved out, there has been time for business process service providers and for technology providers to be developing solutions. So there's now quite a range of ever stronger solutions available to you in the market. Before we turn to those, we just want to really take stock of these challenges and see where you think you are against that range. So if we can have our second polling question. So the question really here is, how advanced are you? That's obviously a qualitative question, so we've given a few little scaling features here. So starting at the bottom, for some of the others that are not necessarily direct participants in the market, it may be not applicable. There may be some on the line that simply haven't started yet, hopefully not too many of those. Many, in our experience, are in the process of designing what their target state should be. They're at the stage of getting RFPs out, they're talking to service providers, they're talking to technology providers, but they haven't yet made firm decisions. They don't yet have a clear view of what the target state, the target operating model will look like. So the middle one is the target operating model is identified and agreed, but not yet implemented. Fourth one up, implementation underway. Fifth one up, it's complete. So there we are. Thank you. We've got the polls back in. So 2% of our attendees have completed their target operating model. I have to say, congratulations. Well done. That's a long way in advance of many of the regs coming down the track. The majority, 29%, or at least the largest lump, in the process of implementation. 17% still working on what the target state should look like. 15% haven't yet started. That's clearly quite worrying. Good to see it's only 15%, but quite worrying that still 50% have not yet started. Good, thank you for that. And just as a reminder for this and all the other polls, your responses are anonymous. Okay, so now let's turn to solutions. And I guess the starting point, Paul, is probably selection of brokers and CCPs.
Thanks, David. Yeah, so let's take a look at some of the solutions to these problems and maybe how we approach them. Anybody who was on our previous webinars may well have seen this little wheel, which outlines in some more detail the types of challenges, individual challenges that you have to look at in terms of working out where you're going to trade and maybe how you're going to trade, or simply how you're going to collateralize your trading. And for the purposes of the audience here, what we're really talking about is the top right-hand quadrant, which is about the counterparty optimization. In your case, we're talking here about your bilateral counterparties who you're already dealing with, but predominantly the CCPs and the FCMs that you're going to have to trade to clear through for some of your trading activity. And without going into the detail of these points here, your target operating model obviously has to work out where you're going to clear, but where also you're going to do your collateral management through. And there'll be many costs, there'll be many advantages for different FCMs that you will perceive as being worth going with that particular clearing broker or another. And this is something that anybody who's doing business under Dodd-Frank is already having to do and is doing. And relatively far down the line of choosing these, the clearing brokers and CCPs, also on all sides of the business. It's something that's being done, but predominantly being done outside of the current target operating model, because you're still trying to work out what that model really is and how it's going to work. And in many cases, it is a spreadsheet controlled system or something that's been built in-house that maybe not the target model, but is something tactical to deal with it right now. Furthermore, for those firms who do have access to their or their clients' large portfolios of eligible or liquid assets, there's the bottom left quadrant, which is about how you use it. It's collateral optimization. And really the fundamental thing there is whether you're using the most appropriate collateral, which is the cheapest to deliver. It could also be viewed in terms of being the hardest to place, because that means you can use less liquid but eligible assets and use them in lieu of anything that's more liquid. And obviously we hear quite a lot when asked the question, what do you tend to deliver from a terms of non-cash collateral? We hear people say, well, we give them a very large piece of one govy. So that's the simplest option, but there are other ways of doing it. And as I mentioned before, our experience is that some of the buy-side firms that we deal with are the most advanced that we've found in that particular area, the collateral optimization, and have implemented tools within their systems, which tend to be more modern, newer collateral management systems, which also manage stock lending and repo, to actually be able to proactively predict what should be delivered. Substitution is a bit more difficult on that, but I won't go into more detail on that, other than it's the starting point for your solution for the target operating model, the decisions, the factors, the type of optimization that you're thinking of in terms of your ultimate future state. And really this diagram should be read from the outside in. Now, whoever or whatever you do, however you do this, as we've alluded to, there will be significant operational and technological challenges to be tackled. So, what are the most appropriate solutions for this?
David Field speaking. So there are two types of solution that we've seen emerging in the market. There are the business process outsourcers and there are specialist technology providers. And because of delays in regulatory dates, both have had the opportunity to further develop their services in discussion with the market. So we're seeing a significant maturity over the last 12 months, so offerings becoming much stronger. Let me take the first category first. So these are the people who will, these are firms who will provide a BPO, a business process outsource service. So from your point of view, you can look at these functions we talked about, look at the key process and simply hand them off to a third party to execute them on your behalf. What kinds of firms are these? Well, typically they are firms already servicing the buy side with some form of service or other, who are seeking collateral management as a value add from their point of view. For example, custodians. So you will have one or perhaps many custodians who are providing custody on a pretty low cost per asset under management, and they see an opportunity to add collateral management. Since they're seeing your assets anyway, then perhaps they can manage those assets on your behalf, handle the eligibility, haircuts, movements, etc. So there are definitely outsourced collateral management services available from some, but not all custodians. Second category of BPO provider is the clearing brokers, all of whom have had to create significant, quite expensive infrastructure to handle their house OTC business and all of its house collateralization. For those that have decided to offer clearing brokerage, and many have had to in order to keep their customer franchise, they've also realized that they pretty much have to offer a clearing brokerage service at pretty low cost, if anything. So market practice seems to be emerging that frankly, they're not going to make much money out of the investment in infrastructure to handle client clearing, to clear on your behalf. So they're looking around, casting around for value-add services to provide, and collateral management is one of those, along with transformation through their repo and stock borrow lend desks. So you should, I would expect you to be seeing your clearing brokers and FCMs coming to you, beating a path to your door, offering you value-add services, including collateral management. And then the third category, I would say, is the ICSDs, so Euroclear, Clearstream, already seeing various parties in the market, large pools of assets through the tri-party and stock borrow lend services. So it's an obvious extension for their services to provide collateral management. In some cases, we're seeing either custodians or sell-side firms white labeling those ICSD services and offering those to buy-side firms. So there's a significant opportunity for investment managers to outsource more or less big chunks of process. And clearly, if you can outsource that at acceptable risk, then that's great news because it reduces the scale of the problem. The second category of solution is the technology providers. I hesitated to put up an architecture, so I've just put up a very simple functional model. I'm not going to go through it, and it's not necessarily intended to be readable, but there's a set of business functions that you will need to have covered. And those that you can't outsource or don't want to outsource, you are going to need to have technology to cover. Let's hope we can all agree spreadsheets won't be enough. There are two categories of technology sourcing we've seen. There are the technology providers that have come from an OTC background who've set up variously, front office or back office OTC processing systems. You can probably think of the names, but probably be invidious of me to mention that on a 4sight webinar. And they have moved into the collateral services space. Those are big systems. They're expensive, complex to implement, and they will fit some, but there'll be many that won't fit. And then there are also the securities finance specialists, typically smaller packages that are more specialist, often come from a repo background or an SBL background, and they have also moved into collateral management. I'd also point out that really with all these technology providers, well, sorry, not all, but some of those have also recognized that for buy side, the very fact of trying to implement brand new software is expensive. So we're beginning to see the emergence of software as a service coming from that. And we'll talk more about that later on. Let me first of all just drill a little bit more detail about the service providers. So what we're seeing at Real Financial is some combination of business process outsource and technology provision. We don't think either is the whole solution. We think it's likely to be some combination. So from the perspective of the service provider, what is it they could provide to you? So this very simple wheel, this is a collateral ecosystem we put together, or at least rather a very simplified version of it. So the way we see it, within the investment manager, there you, the client, so you have your trading function. You're doing your OTC trade either for hedging or for alpha purposes. That's within your control. But it is then quite possible to outsource all 5 core processes that follow on from that point. The first one being margin processing. So if an outsourced provider is going to do everything downstream from that point on your behalf, then they need to pick up the call, the margin call that's going to be generated from your broker on behalf of the CCP that is going to arrive at your door. So they need to intercept that message on your behalf in order to deal with everything downstream, which means they need to understand the collateral mandate. They need to understand how they're going to select collateral on your behalf, how that's going to get transited from the right account to the right destination, handling all the disputes, any reconciliation. That's all the margin processing. Then we look to service number 3 on this slide is very much geared towards those investment firms, investment managers that are short of eligible collateral, and this is a service provided by an outsourcer to secure eligible collateral on your behalf, again through some sort of treasury or cash purchase or repo or stock borrow lend type of service, so you can transform ineligible collateral into eligible. Having made all those decisions about what needs to go where, service 4 is really all the operational stuff. Doing the actual title transfers, doing the pledges, handling the substitutions when you recall something because maybe something's gone special, handling all the cash around that, all the default management services in the event of a default, and you'd expect to see all of those kind of movement services, collateral operations visible to you through some kind of collateral management portal. And then the final piece of the jigsaw that the service providers will often provide then is reporting. So reporting to you, responding to queries on collateral accounts, alerting you to changes in collateral values, reporting around failed trades, missed cut-offs, just enabling you to see collateral transactions, doing risk reporting and compliance reporting, etc. So what we're seeing is the service providers stepping up. Now they'll call their services variations on these terms, but we're seeing them variously stepping up to provide these as outsourced services. So provided they can pick up and intercept that initial margin call, in theory at least, they can provide you with all of the downstream systems. So that's all I wanted to say on business process outsourcing, but our view is that even if you outsource all of that business process, you are still going to need some form of in-house technology because you have to be able to control it. You're still accountable. So let's talk about the light touch technology solutions that are now emerging. Over to you, Paul.
Thanks. So David's mentioned that there are many options for outsourcing services, which is a good thing. However, there's certainly a need for participants to have certain functions managed internally, because you have to increase the economy of scale as you grow in order to manage just the business as usual processes, but also to make sure that what you're being forced to do from a mandatory perspective is being handled internally correctly, because it is after all your assets, your clients' assets and exposures which are being handled by your collateral cost centers, and you want to reduce the amount of manual processing there, because manual processing leads to mistakes. You want to be able to completely cover, from a compliance and control perspective, all of your risk metrics, whether it be counterparty liquidity, operational, credit, whatever it needs to be, and simply you just want to reduce settlement costs, custodian costs, transactional costs. I won't go through this large box set of points line by line. When you get the slide deck after the presentation, you'll be able to read these, but these are, from David and myself's perspective, the types of activity that you will probably need to have some kind of software solution for. And at the moment you may have really good software solutions, older solutions, spreadsheets, or a combination of them, which is probably more likely to be the case. The problem with that is that in order to actually handle that complexity of business requirements, there's a lot of requirements. There's a lot of STP required. If you have one CCP with one clearing broker, that's 4 new files that you need to process in to your systems. So you either need a vendor solution that already has those feeds, or you're dealing with it manually through cut and paste. And that just takes time, particularly as you want to increase the number of clearing brokers or business or CCPs for you and your clients. You also may want to have a consolidated inventory management system that tells you where your assets are, so that you can filter your availability for you and your clients to see what's actually eligible. And you may also need to prioritize your activity over that of your clients, or vice versa, depending on what your business model is. And then there's also being able to pull in information from those providers that provide data, that provide benchmarking information, and pulling it all together in a centralized inventory and exposure management system. And one thing that's also certainly true is that there's a centralization of this business, where we've called it the collateral trader, but it's usually some kind of collateral hub, a desk, a cost center that tries to pull all of the collateral usage across the different business lines, be it repo, stock lending, derivatives, cleared, and pulls it into one central hub that's aim is to mitigate risk, minimize costs, but you can't do that on a spreadsheet. However, I'm quite conscious of the fact that David's point about outsourcing is the right thing to do. And it's the same when you're choosing a system. It might be used by you internally, and that's the way it should be for certain functions, but do you really want to have to go through the project to host it internally, support it internally, integrate it into your systems internally, when we could, as vendors and consultants in the market, offer a slightly different model which has a smaller footprint, a lower cost of ownership, and that's what we would, the market term for this is software as a service. There are vendors out there that do software as a service. It's not a predominantly common model for the traditional inventory management, collateral management vendors. It tends to be something that is in-house, but it is certainly possible to do it this way, and it's increasingly becoming something that we see the market asking for. So we, like other vendors, are offering this kind of service to buy-side and sell-side clients. Really, it's outsourcing your insourcing. So you have people that you can concentrate your costs on hiring the right people to manage the processes that you need to manage internally, which in effect is managing the processes that you're outsourcing and managing how it's working, and not worrying about your systems and where they're hosted and how they're implemented and how they're supported. This is a model that you may be interested in. If you are, you can certainly talk to us about it. And that's really all I have to say on that model. It's something that we perceive of interest to people as large as the largest buy-side firms and brokers, right down to people who are very small buy-side firms who maybe only have a few CSAs, for instance, which maybe need to be cleared, collateral management controlled, but for whom their use of a spreadsheet is becoming something that's challenging. So it can be a very lightweight footprint, almost like a standardized offering in effect. Now, this is all good, the solutions both in terms of services and systems, but we do have to look at the costs. So there is an impact on the return on investment for this. You have to try and predict how it's going to happen. And whilst we're all interested in the end result, we have to work out how we're going to start. So I'm going to hand over back to David to summarize for the final piece of the webinar. Where do you try and work out that return on investment, and where do you start?
So in a perfect world, if you were to invest in outsourcing and technology to cover all of these points, you'd reach some perfect optimization level where you've secured all of the benefits, but at significant cost. Perfect collateral management requires a very sophisticated solution. But as your collateral management improves, incremental investments will bring progressively smaller returns. So there's definitely a curve of diminishing returns. Let's look at some of the candidate investment areas, and we'll just rapidly step through this and just illustrate where you need to draw the line. So for example, a starting point would be to put a system in purely to manage a single point of inventory and a single point of margining. But then you might also move on to a system which automates eligibility and haircuts, or you might leave that manual. You might then move on to some sort of system that will sequence the collateral. And in some cases we use systems where you can determine your sequencing manually and capture it in a system, and it will then do some kind of auto allocation for you. Or you can move to something more sophisticated, invest a bit more, get some automated, cheaper to deliver. You can move on to automated substitution. You could move on to more sophisticated optimization where you are balancing the hardest to deliver against hardest to please. And ultimately you can go for complex multi-factor optimizations. There's been a lot of chatter in the conference circuits over that real complex algorithmic optimization. Frankly, I think that's several years away, and in our experience at Royal Financial, what we're seeing is most of the market is down the bottom end of the curve of really just trying to sort out the basics. But wherever you are on that curve, there'll be some point at which the incremental investment is simply not worth the incremental benefit. So I don't think anybody here is suggesting that you have to go right to the end of the curve, or even if you do, that may take some years. I think it's work out where you are and get the basics in place, and with the impending dates, you need to do that pretty quickly. So even if it all looks very complicated, you can't afford to put your head in the sand and do nothing. You have to make a start, and where you start depends on your current status, the impact of regulations on your particular business, and where your drivers are, where you sit on the curve of cost avoidance versus risk reduction versus customer service. So the real question really is, to our mind, is where do you start? So the way we see it, it's a journey. From change preparation, which we saw earlier on, is where some of the audience today is currently at, through to designing a solution, delivering and executing that solution, and then ultimately handing it off into kind of run the firm operations and support. Because the work we've done with both sell-side CCPs and custodians all around collateral infrastructure, and now the work we're doing the buy-side, we've seen how that journey operates around collateral management for all aspects of the market. So there are various assets you can leverage. For example, you really need to start with vision and goals. What are you trying to achieve? What does that look like? How do you measure that? What does good look like? And then the solution design is very much around the target process model. Collateral processing does vary depending on who you are in the market, but there's an awful lot of commonality. A good 70 to 80% of collateral processing is common, independent of firm type. So you can leverage existing process models and simply tweak them for your purposes. Having worked out what your target process model is, you need a target architecture. So of those processes, what are you going to outsource? What does the boundary look like between an outsourced provider? What's the SLA across that boundary? What's the control? What you've got in-house, how are you going to support that own technology? Existing technology, new technologies, outsource, software as a service type technologies. And there are business requirement documents you can leverage that pre-exist. There'll be probably 60-70% of your requirements. So you need RFIs around those service providers, RFIs around technology providers. Get your vendor selection sorted out so you can clarify and firm up what is your target state. Then you're ready to move into implementation roadmap to hit the dates and hit those key milestones. So there is a pretty standard process, I would say, a pretty well tried and tested roadmap for getting from wherever you are on that curve through to meeting those target dates. But as is conventional on these calls is to say you really can't afford to wait anymore. So particularly for those that haven't started, you really do need to get on with it. So as we draw to a final close, have I got time to cover a couple of questions now or before we close up, Paul? So there were some questions raised along the way. First question was, which activities should the buy side be prioritizing? So hopefully I've probably covered that in that last slide. Depending where you are, if you haven't started, what are you trying to achieve? If you have started, we would strongly advise seeking real clarity on the target state you're trying to get to in both business terms and architectural terms. Because unless you've got clarity around that, then your projects are not all aligned, you're not gearing towards a common goal. So establishing a common goal is very key. Next question we've got is individual segregation, i.e. LSOC, a regulatory requirement, or is Omnibus okay? The answer is that the regulations require CCPs and brokers to offer both Omnibus and individual segregation. The regulations do not force an investment manager to choose any one of those, so it is your choice, and therefore you have to analyze the pros and cons of which you what you want to work with. Third question, individual segregation with asset protection is an EMEA requirement, but I indicated that it's optional. I think I've hopefully probably just covered that. So it is not an option for a CCP or for a clearing broker or FCM, but it is an option for the buy-side firm. The buy-side firm is entitled to decide whether they want individual seg protection or whether they are comfortable with the lower cost, higher risk route of Omnibus. Okay, those are the questions raised so far.
Okay, thank you very much, David. And we've got a couple of minutes left, and actually there was one more question raised, and I will just give a little bit of an answer about it, which is, it's talking about optimization. I think somebody picked up on the wheel that outlines some of the optimization options that are open to people, and it's an interesting topic because everybody has a very different idea of what optimization means to them. Now, the thing about optimization, in fact, if we go back to the slide that David covered here, is that it really starts, you start getting into optimization when you get up into the middle where you're looking at cheapest to deliver. And even doing that is actually relatively complex because you have to have done the first 3 steps first. And that involves consolidating a lot of data from a lot of sources. Now, on paper, that's not a complex thing to do, but it can be quite a long-winded thing to do because you often have many systems that have bits of inventory, bits of eligibility schedules, etc. So if you're the kind of large buy-side firm that has, say, 23,000 legal agreements and they're all in PDFs, that's a problem you have to deal with on its own that's not complex but is very time-consuming. And therefore, you're talking about somebody billing you by the hour to do that, whether it's internally or externally. Now, there are people who are up into that. When you get into auto cheapest to deliver or beyond, we're talking about collateral optimization algorithms. And one of the questions there is about how you do it in terms of what kind of algorithms do you use. Now, this is a whole technical conversation of its own. Simplex algorithms, IBM iLogic algorithms, they're all variations on a theme and they're certainly usable. What we need from clients is a clear target process model that defines their optimization in intricate detail in terms of exactly how they want to do it, because the other option is that we as vendors of systems simply provide something that's relatively generic, tell the market that they can use it, which is fine. But what we tend to find is that people say, well, yeah, that's kind of there, but it's not quite what we want. It's something different. So we almost end up reinventing it when we see different clients. But anybody who's interested in talking about automation of collateral optimization is welcome to give us a call because it's a very interesting subject. Interestingly, creating the optimization algorithms is not the difficult bit. The difficult bit is getting your data set into that point. It's actually consolidating the inventory, eligibility, haircuts, schedules, MTAs, all of that takes more, that's more costly.
Paul, I would very much endorse that. In our experience, we've seen a lot of chatter around optimization, and it's a very stimulating, interesting conversation, but frankly, the bulk of the industry is at the left-hand end of this curve. So our advice is focus on getting a single inventory, focus on getting all your margin calls into one place, focus on basic reference data, eligibility and haircuts, get the basics in place and worry about sophisticated optimization at some point in the future.
Okay, at this point we are literally 20 seconds away from the hour. There are other questions that have come in from other people. We promise that we will answer them directly with you immediately following this presentation or in a couple of days ahead. But we'd like to thank all attendees for participating. We very much appreciate that you took the time out to spend with us. We trust that you found the content interesting, illuminating and interesting. And please be in contact with either David or myself with any follow-ups that you might have. You can email us, you can call us, you can take us out for dinner. And we'll leave it there. So thank you very much.
Here's goodbye from him.
There's goodbye from me.